Hello, this is Joe Wallen.
And Susan Shalla.
Thank you for joining us today. Today we're going to talk about the tax consequences to founders of starting a company.
Right, yeah, so typically a founder will get restricted stock. That's what investors want to see, that you're going to be at the company for a while, that you've got something at risk. So if your stock that you're getting is subject to vesting over time, that's called, for tax purposes, subject to a risk of forfeiture. So if you walked away from the company, you'd leave some on the table that were unvested and the company could yank back. So when stock is subject to a risk of forfeiture, you can make an 83B election to have the tax consequences in your holding period start as of that date that you make the election.
Right, and the consequence of, so what we're talking about here is if you receive stock in a company subject to vesting, and by vesting we mean the company has the right to repurchase the stock at usually the lower fair market value or cost. So if you buy your founder stock for $1,000 and you got 1 million shares and they were subject to vesting over 4 years, such that if you quit 2 weeks later or a month later, some number of shares will be forfeited back. That's what we're talking about, is a substantial risk of forfeiture. In that situation, if you don't do anything, if you don't make an affirmative election to be taxed on the receipt of the shares, then as the shares vest, you owe tax. And so if the shares go up in value, you can quickly see how this can become a really burdensome tax problem. Not only burdensome because you've got federal income taxes, but you've also got employment taxes and withholding taxes on the company side they have to manage. And so it's really important, if you found a company and your shares are subject to vesting, that you file an A3B election. This election has to be filed within 30 days of your receipt of the shares, which is not 30 days from incorporation. It's 30 days from the date of the company and you actually signing your stock purchase agreement.
Right, right. And 30 days, that's a hard and fast period. There's no, leeway on that. So we recommend that you get that going right away. And when you correspond with the IRS, the best way to do that is sending things via certified mail, because the IRS says that that is evidence of, actually mailing the document. And then we recommend that you actually have that return receipt requested as well, so that you get that file stamped, received, back in the mail, and then you can keep that as evidence that you filed it on time.
Right, yeah, sometimes we run into founders who filed it, or at least they have a strong recollection they filed it and they put it in the mail, but they didn't keep a copy of it. And if you do that, calling the IRS to attempt to get a copy is not a fun activity. You'll spend hours on the phone. It's horrible.
Right.
And we've actually written a blog post. If you type into Google, 5 things to remember when you file your A3B election, you'll find like a little instruction kit, including a cover letter to send to the IRS, which says, enclosed please find the originally executed A3B election for John Doe with respect to XYZ company. And we recommend you file these with a wet signature.
Oh yeah. DocuSign doesn't really work with the IRS.
Well,
there's a
question. I mean, I wrote a blog post earlier this year saying, hey, Mr. New President, I mean, why don't you do something good for founders and just expressly say, by executive order, I decree that electronic signatures work on these forms, and they ought to work.
They ought to work.
They ought to work. I mean, I'd be dumbfounded to me if they didn't, but the paranoid tax lawyers in America, that's actually a trade association, they will demand you do originally executed signatures on these things.
Right.
And so in any event, I mean, A3B elections, if your shares are not subject to vesting, you don't need to worry about that. So if you and I founded a company and we're 50-50 owners and we didn't have any vesting in our shares, which may not be the recommended corporate structure, but if we didn't have any, we wouldn't have to file an A3B election.
Right.
Another question we frequently hear asked is, do I have to file an A3B election on options?
Right, yeah, and the answer is no. It's not even eligible for an 83B election.
Right, the way Section 83 of the code is written for the tax geeks in the crowd is that it only applies to property which has a readily ascertainable fair market value, and if you are a private company and your options aren't traded, then there's no readily ascertainable fair market value. I think that's the way the code is written, but the upshot is if you receive a stock option, you haven't received stock, so you can't make an A3B election. You can only make an A3B election with regard to stock,
right,
not options.
Right. Yeah, so when you're making an 83B election, when you first found a company and you first sign your restricted stock purchase agreement, we recommend that you do that before your company goes on to sign up, some valuable contracts or licenses or anything else like that, because at that point where you've just got an idea and you've just started the company, you can say with a straight face that the fair market value of what you just received in restricted stock is zero or close to zero.
Yeah, usually when founders found a company, they collectively decide, hey, how much should we start our bank account with? And they decide, well, let's start the bank account with $6,000 in it, and if there are 3 equal founders, they'll each put in $2,000 for their shares. That's what they'll pay for their shares, plus their IP contribution. And then on your A3B election, you simply recite that
you put in 2,000.
The shares were 2,000, and you paid 2,000. Therefore, there's no income on the election, and then the election, stops that whole problem of having income when the shares vest, which you want to avoid at all costs.
Right. Yeah, and the company wants to avoid that too, because on the company side, they would have to do a payroll withholding on that as it vested later. So.
Right, and you want to keep. You want to have this record in your file that you filed the election, you got the certified mail, return receipt, requested slip. You want to have all that as part of your corporate records.
Right.
So that if you're involved in a financing transaction and your financing investor wants to see your diligence, they'll see these elections and they'll know everything was done correctly, and the company doesn't have any potential ongoing liability for employment and income tax withholding.
Right. Yeah, and making that 83B election, when you receive that restricted stock, that starts your holding period for long-term capital gain. So if you hold it for a year and a day, you get long-term capital gain if you then sell it or it gets repurchased by the company. And then the other thing about holding periods that we should talk about is that 1202 qualified small business.
Yeah. So we had two general issues to talk about to you today. One was the A3B election on the issuance of founder stock, and then the other one was what's called the qualified small business stock benefit, and this is a significant tax benefit to founders of companies as well as investors. Do you want to explain it?
Yeah. Generally, if you've held your stock in a C corporation for 5 years, and then you sell the stock, you can exclude from capital gain and from tax up to $10 million worth of capital gains.
Yeah, so it's a big deal, this qualified small business stock election.
Yeah, money in your pocket that you didn't have to pay taxes on.
Right, and you can only do it with a C Corp. You can't do it with an LLC. Now, if you formed an LLC, you could convert the LLC to a C Corp and then start a qualified small business stock holding period, which has to be 5 years. But if you form as an S Corp, your founder stock cannot qualify.
Right.
So you can really miss out. We had a founder not too long ago. He had formed an LLC, and then he had worked away for about a year and a half, found some investors, converted to a C Corp, did this venture financing, and then approximately 4 years after that financing event, sold the company for a lot of money.
Right.
And he did not qualify because he didn't meet the 5-year holding period,
Right.
which he would have met had he started as a C Corp from the start. So
Yeah.
for him, it was a couple $1 million in taxes he had to pay that he otherwise wouldn't have had to pay at all. So it's kind of, it's a significant tax benefit to think about.
Right, yeah, and unfortunately that time when the company was an LLC, it didn't tack on
Right.
to his holding period of the stock.
Right, you've got to have C Corp stock and you've got to hold it for 5 years. The company also has to be in a qualified trader business and can't have more than $50 million in gross assets before or after the issuance of the shares. Usually the $50 million thing is not a problem.
Not a problem.
Although we have had venture financings which were, if you do a $60 million venture financing,
Right.
say for example, you can't give the qualified small business stock right to your investors because you'll have more than $50 million in gross
Right.
assets after.
Yeah.
But usually that's not a problem for a startup.
Right.
Usually the problem for a startup is their business a qualified trader business? And this is basically a business that's not a services business, so it can't be lawyers or doctors or accountants.
Yeah.
But most software businesses are gonna qualify for this, so it's something to really seriously consider when you form a company.
Yeah. So that's it.
Those are our thoughts today on tax issues for founders. Again, to summarize, the A3B election, really important. Don't miss it. 30-day deadline, no reprieve. And then the qualified small business stock benefit. It's something to really seriously consider when you choose your type of company.
Yep. Thanks.
Thanks, everybody.